Imagine losing 90% of your investment portfolio in a single market crash. This devastating reality hit millions of investors during the Great Depression, wiping out fortunes overnight. Yet during this same catastrophic period, a select group of investors not only survived but thrived, using a revolutionary analytical approach that would forever change how we evaluate securities. This approach was codified in security analysis by Benjamin Graham and David Dodd, first published in 1934. Their methodology transformed investing from a game of chance into a disciplined science, creating a framework that would guide legendary investors like Warren Buffett to accumulate billions. The book establishes a fundamental distinction that most people still misunderstand today. Investment, according to Graham and Dodd, is an operation which, upon thorough analysis, promises safety of principal and an adequate return. Everything else is speculation. This means that buying a stock simply because its price has been rising, or because you believe the company will dominate the future, is not investing. It is speculation. True investment requires three essential components: thorough analysis based on established facts, protection of your capital, and reasonable return expectations. The cornerstone of security analysis is the concept of intrinsic value. Graham and Dodd argue that every security has an inherent worth determined by its assets, earnings, dividends, and future prospects. This intrinsic value exists independently of the market price. The market, driven by fear and greed, often prices securities far above or below their true worth. The intelligent investor exploits these discrepancies, buying when market price falls significantly below intrinsic value and selling when it rises above. To determine intrinsic value, Graham and Dodd developed a comprehensive analytical framework examining three primary areas. First, the balance sheet analysis focuses on the company's assets and liabilities. They emphasize net current assets, calculated as current assets minus all liabilities. When a stock trades below its net current asset value, you're essentially buying the company for less than its liquidation value, creating a substantial safety cushion. Second, the income statement analysis examines earning power. Graham and Dodd stress that earnings must be averaged over several years, typically 7 to 10, to account for business cycles. They warn against accepting a single year of exceptional earnings as representative of true earning power. The authors introduce the concept of earnings quality, distinguishing between recurring operational earnings and one-time gains. Only sustainable, high-quality earnings should factor into valuation calculations. Third, the authors examine the company's financial structure and management quality. They analyze the ratio of debt to equity, the terms of bond covenants, and the allocation of earnings between dividends and retained earnings. Conservative financial structures with low debt levels provide additional protection during economic downturns. Management that maintains consistent dividend policies and prudent capital allocation demonstrates commitment to shareholder interests. The margin of safety principle represents Graham and Dodd's most enduring contribution to investment philosophy. This principle states that you should only purchase securities when they trade at a significant discount to intrinsic value, typically at least 30 to 50% below. This discount provides protection against errors in analysis, unforeseen events, and market volatility. The margin of safety transforms investing from a prediction exercise into a protection strategy. You do not need to accurately forecast the future if you buy with sufficient margin of safety. Graham and Dodd categorize securities into distinct classes, each requiring different analytical approaches. Fixed income securities, including bonds and preferred stocks, demand analysis of coverage ratios. The authors recommend that earnings should cover bond interest at least 5 times over for industrial companies. For utilities, 3 times coverage suffices due to their stable revenues. They examine not just current coverage but historical consistency through various economic conditions. Common stock analysis presents greater complexity. Graham and Dodd divide common stocks into 3 categories. Investment-grade stocks are established companies with long dividend records and stable earnings. These can be purchased when their dividend yields significantly exceed bond yields, compensating for additional risk. Speculative stocks lack established earnings records but may offer substantial appreciation potential. These should constitute only a small portfolio portion. Bargain issues are stocks trading below liquidation value or at extremely low multiples of average earnings. These situations offer the greatest margin of safety. The authors dedicate substantial attention to market psychology and its impact on prices. They observe that market participants oscillate between excessive optimism and unwarranted pessimism. During bull markets, investors project current prosperity indefinitely into the future, paying astronomical multiples for earnings. During bear markets, they assume current difficulties will persist forever, abandoning sound securities at a fraction of their worth. The intelligent investor maintains emotional discipline, buying when others sell in panic and selling when others buy with abandon. Graham and Dodd emphasize that security analysis is not about predicting short-term price movements. They explicitly reject technical analysis and chart reading as speculation tools lacking analytical foundation. Instead, they advocate patience, allowing time for market prices to converge with intrinsic values. This convergence may take months or years, but the mathematical relationship between price and value ultimately asserts itself. The book introduces several specific valuation techniques that remain relevant today. For stable businesses, they propose capitalizing average earnings at an appropriate rate, typically 8 to 12 times for quality companies. For asset-rich companies trading below book value, they examine whether assets could be liquidated or better utilized. For growth companies, they warn against paying excessive premiums for future prospects, noting that few companies maintain high growth rates indefinitely. This brings up an interesting question that relates directly to modern markets. Given that today's technology companies often trade at multiples that Graham and Dodd would consider speculative, which of their principles do you find most challenging to apply in current market conditions? Let us continue with their framework for special situations. Graham and Dodd identify several scenarios offering exceptional profit opportunities for analytical investors. Reorganizations and liquidations often create pricing inefficiencies as investors flee uncertainty. Merger arbitrage situations provide defined returns with calculable risks. Rights offerings and spin-offs frequently result in temporary mispricing as investors sell without analysis. The authors stress the importance of diversification, but not excessive diversification. They recommend holding between 10 and 30 securities across different industries. Fewer holdings concentrate risk unnecessarily, while more positions dilute returns and exceed monitoring capacity. Each position should be selected through rigorous analysis rather than random diversification. Graham and Dodd address the criticism that their approach seems overly conservative. They argue that speculation is not inherently wrong, but it should be recognized as speculation, not disguised as investment. Speculators should limit their exposure to amounts they can afford to lose completely. The tragedy occurs when people speculate with funds required for living expenses or retirement, believing they are investing. The book's final sections examine the institutional framework of markets. Graham and Dodd critique Wall Street practices that encourage speculation over investment. They observe that brokers profit from activity, not client success, creating misaligned incentives. They advocate for investors to ignore market quotations except when advantageous for buying or selling. The market should be your servant, not your master. The enduring power of security analysis lies in its systematic approach to risk management. Graham and Dodd do not promise spectacular returns. Instead, they offer a methodology for achieving satisfactory returns while protecting capital. Their emphasis on facts over forecasts, value over momentum, and patience over activity provides a sustainable framework for long-term wealth creation. The principles outlined in this masterwork have guided successful investors for nearly a century. Warren Buffett, who studied under Graham at Columbia, credits these concepts as the foundation of his investment philosophy. The margin of safety, intrinsic value analysis, and the distinction between investment and speculation remain as relevant today as during the Depression era. Understanding these principles transforms how you view markets. Instead of fearing volatility, you recognize it as opportunity. Instead of following crowds, you maintain independent judgment based on thorough analysis. Instead of seeking quick profits, you build wealth systematically through disciplined application of proven principles. Thank you for joining me in exploring these timeless investment principles. If you found this summary valuable, please subscribe to the channel where I upload new book summaries daily to help you master the world's most important ideas. Your likes also provide essential feedback that helps me create better content for our community of lifelong learners.